Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of corporate filings, which is like trying to find a matching sock in a dryer full of paperwork. Today we are diving into PharmaCyte Biotech's latest quarterly report, where we will see that a big investment led to some mixed results. We're going to break down this report to see what's really going on with PharmaCyte. The main things we'll look at are the company's money situation, how it's performing, and some important changes that could affect its future. We'll keep things simple so everyone can follow along. Let's dive straight into the money. Looking at the balance sheet, as of January, their cash and cash equivalents stood at $16.4 million, a big drop from $90 million April. That's like losing over 2/3 of your savings in just 9 months. Total assets decreased as well from $59.9 million to $43 Tanchi, but whether it pans out remains to be seen. Moving on to the income statement, there's not much to say about revenue since there is none. The company is still in the development stage and needs to be judged on its expense management. The net income paints an interesting picture. For the 3 months, they had a loss of $3 million, but for the 9 months, they actually had a profit of $18.9 million. The increase in profit for the 9-month period is due to a nearly $22 million benefit on a related party investment that offset a 3% to $20 shares. The net income applicable to common shareholders drops considerably. Let's focus on a key number, the basic and diluted loss per share. For the most recent 3 months, it's a 0.44 foreign loss compared to a 0.65 loss in the same period last year. So they're losing less per share, but still losing. For the 9-month period, however, it's 1.67 profit per share, which is great compared to a $1.47 a cent force per 9-month profit, since operations are still quite lossy. This statement gives us a snapshot of the components of company worth. We can see that the company had an increase in treasury stock as they have continued buying back their own shares. However, they have fully redeemed the Series B stock with some payouts still in progress, which reduces the equity. Switching to the statement of cash flows, the company's cash position gets clearer. $33.8 million decrease, which shows the net effect of all the moving parts. We see that a lot of the outflows are from acquiring the TNF investment and repurchasing shares. We can see the key number that they've spent about $25 million on those activities in the past 9 months. Now, what does PharmaCyte actually do? They're trying to develop cellular therapies for cancer using something called cell-in-a-box technology. Basically, they want to put live cells inside tiny capsules and use them to fight cancer. It's a long shot, but if it works, it could be huge. However, they are still dependent on SG Austria and its know-how. They are also having issues with FDA clinical trials and regulatory requests. There is an ongoing clinical hold with the FDA, which is a major roadblock. The FDA has a list of concerns they want addressed before PharmaCyte can move forward with human trials. The company needs to provide more data and perform additional studies. They've hired experts to help, but it's unclear how long this will take or if they'll even succeed. Scroll note 2, summary of significant accounting, couple issue scroll. This section emphasizes they're a smaller reporting company, so their report doesn't have all the bells and whistles. Also, the report is unaudited, meaning that there is no external source attesting the information is valid. We can also see a major risk factor that they need to be able to fund operations for the next 12 months and their ability to access capital is not assured. The company owns 13.9% of SG Austria. These subsidiaries also have some issues relating to revenue, which will impact the company's finances in a negative way. There's also reliance on related parties for consulting fees, which can raise red flags to investors. These transactions must be carefully scrutinized to avoid misleading financial practices. It seems that this small company is being sued by someone claiming breach of contract. It's hard to tell how it will play out, but it is something to keep an eye on. Now, let's zoom out and look at the big picture. PharmaCyte Biotech is a company at a crossroads. They have some promising technology, but they're facing major hurdles. The FDA clinical hold is a serious issue that they need to address quickly. But for now, the timeline is in limbo and they have no revenues. That lack of revenue makes them highly reliant on the success of their TNF Pharmaceuticals investment, where they recognize a gain on an investment of $21 million. One of their big strengths is the experienced team they have assembled, though it's unclear if it will be enough. A major weakness is their reliance on third parties, especially SG Austria, for the know-how and success of their core technology. Plus, their cash is dwindling fast. Overall, PharmaCyte is a high-risk, high-reward company. If they can address the FDA's concerns and get their clinical trials going, their stock could soar. But if they fail, there's a real risk of financial trouble. Thanks for watching, and I hope you enjoyed this video and learned something new. Please subscribe, like, and comment below.